Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Stochastic RSI swing trading strategy, a powerful combination of indicators that potentially enhance your ability to identify profitable entries and exit points in the Forex market. So by the end of this video, you would understand what the stochastic RSI is, how it differs from your traditional indicators, and most importantly, how to implement it effectively in your swing trading strategy. So you have to stay tuned as we break down this strategy step by step, providing you with actionable insights to potentially improving your trading performance. We start by understanding what the stochastic RSI is, and this is a powerful momentum indicator that combines two popular technical analysis tools. The first tool that it combines is the relative strength index and the stochastic oscillator. This hybrid indicator applies the stochastic oscillator, the formula of the stochastic oscillator, to the RSI values instead of price data, resulting in a more sensitive and responsive tool for traders. Remember, the stochastic RSI operates on a scale from 0 to 1 or from 0 to 100. It operates from a scale from 0 to 100. With readings above 80 considered overbought and readings below 20 considered oversold. These levels help traders to identify potential reversals and trend changes in the market. So there are several advantages of this indicator over traditional indicators. Now, this stochastic RSI has an increased sensitivity compared to other indicators. It can detect changes in momentum before they become apparent in price action. The second advantage is it always gives us early signals. It provides early signals for entries and exits compared to the RSI alone. The third advantage is its trend confirmation. It helps us to confirm the strength of existing trend or identify potential reversals. While the fourth advantage is its divergence detection. The stochastic RSI is useful for spotting divergence between price action and the momentum, which can signal upcoming trends and changes. So when using the stochastic indicators, traders often look out for crossovers between the indicator two lines, between the indicator K line and the indicator D line, and monitor when the indicator moves in and out of the overbought and oversold territories. These signals can help identify potential entries and exit points. So let's see how we can incorporate the stochastic RSI to our swing trading strategy. The first step is to set up your chart by opening your 4-hour chart or your daily chart, because these are the time frames we use for swing trading. You set up your chart, you choose the currency pair you are willing to trade with, and I'm making use of our Euro card pair, USD dollar against the Canadian dollar. Remember, the 4-hour or the daily time frame is an ideal time frame for swing trading because it has a good balance between noise reduction and timely signals. The next step is to add a simple moving average of 180 period. Adding a 180 period simple moving average would help us with this strategy. This will serve as a trend filter and potential support and resistance level. Apply the stochastic indicator using the following settings. Now, the setting for the stochastic indicator is our K has to be 3, our D has to be 3, our RSI period has to be 14, and our stochastic length has to be 14. This is the setting for our stochastic RSI or our Stoch RSI. Now let's get down to identifying the trend, which is the second step. You identify the trend. We have to use the 180 moving average as our primary trend indicator. When price is above the simple moving average, consider the trend bullish. While price is below it, you consider it bearish. This step is crucial as it aligns your trade with the overall market direction, potentially increasing your success rate. So you wait for the pullback, you wait for price to pull back to at least the 180 simple moving average. When price pulls back to the 180 simple moving average, in a buy trade, in an uptrend, you wait for price to pull back to the simple moving average. When price pulls back to the simple moving average, we will look for our buying opportunity when price pulls back to the simple moving average. While in a downtrend, you expect price to rally back up to the simple moving average, the 180 simple moving average. In a downtrend, you expect price to rally back up to the simple moving average before you confirm your trade entry. Now, when price gets to the simple moving average, let's look for an example when price came in contact so that I wouldn't confuse you guys. In a buy scenario, you can notice that price is constantly above the 180 moving average. We just have to wait for price to come back and retest the 180 moving average. And 180 moving average will have to act as a support region, while in a downtrend it will act as a resistance region. When it comes back to retest, we have to check our stochastic indicators. For a long position, we check our stochastic indicator to see if price is rising below the 20, and as we can see, price is below the stochastic indicator. The stochastic RSI indicator is below 20 at this area, rising below 20. As you can see it indicates that the momentum is about to shift back in the bull's favor after a pullback. While in a short position, in a downtrend, you have to wait for the stochastic indicator to fall above the 180 region. Now you enter your long trade the moment price bounce off your 180 moving average and you notice there is a crossover. As we can see, there is a crossover between your D and your K line at the area when price bounced on our simple moving average. When price bounce, this is where you enter. When you confirm the crossover and price is moving from below the 20 area in your stochastic oscillator. This is where you enter your trade and you expect price to push to the upside. Now in a selling scenario, when you are looking for a selling trade, you would first of all wait for price to be trading below the simple moving average, and you wait for price to come back to retest the simple moving average. That retest has to happen at an area where the stochastic RSI is above the overbought region, which is above 80. When price is above 80 and you can notice your retest is happening at that side, you look for a crossover before you enter your selling position. As we can see, there is a crossover between the K and the D line. You will now enter your trade after price has come to retest your simple moving average. This is where you enter your sell position. Remember to set your stop loss. In a buy trade, you set your stop loss below the swing low. You can set your stop loss 50 pips below the swing low. Since we are using a swing trade, you set it 50 pips below the swing low. Once you set it 50 pips below the swing group, you aim for a profit target of at least 1:2 or 1:3, as the case may be. While in a sell trade, you set your stop loss above the swing high, 50 pips above the swing high, to give the trade enough room since you are swing trading. Your take profit should be at least 1:3, as the case may be. Minimum of 1:2, 1:3, as the case may be. You can manage your trade by implementing a stop loss, trailing stop loss, by locking in 50 pips in profit when price moves in your profit. When price moves in your direction, at least 1:1, you can put your stop loss above entry, locking in your profit. This is going to help you to trail the stop loss, trail and gaining profits while price moves in your favor. You move your stop loss in the direction of your trade every time price moves 50 pips in your favor. Consider exiting the trade when the stochastic RSI reaches the opposite extreme. Now for a long trade, for a short trade, when price reaches your oversold region, you decide to leave the trade. This is where you can leave the trade. Then in your buy trade, when you are in a buy position, you will leave the trade when price gets to your overbought region on the trade. This is where you will decide to exit your trade. You have to always keep an eye out for potential reversal signals, because this can include the RSI cross back over into the overbought and oversold territory, or you can see a divergence between price action and the RSI and the stochastic RSI, or price crossing back over the 180 simple moving average in the opposite direction of your trade. These are signals that would help you to exit your trade in a swift move by monitoring your trade. Remember, while this strategy can be effective, it is crucial to practice proper risk management. Never risk more than 1 to 2% of your trading account on a single trade, and always test new strategies on a demo account before implementing them with real capital. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on trading tips and strategies. Thank you for watching, and I will see you in the next video.